Today's tutorial session, Kathy will be doing one-to-ones with you, and while she's doing that, I want you to be looking into this and sort of preparing and thinking about how you can manage your money better now and in the future. Essentially how to be smart with your dollar, but with pounds, because obviously we're in England. So, but when you say pounds, it doesn't sound quite as good. Right. So the intent of this session is to enable you to make smart choices when managing your money and to help you from accidentally getting yourself into debt. And you may think of debt as like big loans that you see on kind of things like can't pay, we'll take it away. But actually debt just means owing somebody somewhere something because you didn't have that money at the time. Okay, it can be as small as 10 pence, 1 pence, but debt is debt. And it shouldn't be thought of as like things that happen to big adults. It happens to all of us all of the time, and it's about thinking about how we can plan things from behind the scenes to ensure or to encourage us not to go down that route. So in this session, so last year several of you commented about wanting to learn about money and finances, things like mortgages and so on, which we will come to in other weeks. So today we're just focusing on this part of finances. So with your progression in mind, obviously you'll be leaving in 6 months. It's super sad, for me at least, because I'll still be stuck here, but you'll be off doing wonderful and amazing things, I hope. And these skills will basically allow you to think effectively about it. Again, I've missed a bit of writing there, perhaps you didn't type. But essentially, allow you effectively to think about it. This should be in it at the end. And these are things that I wish I'd been told when I was your age, because now I'm older and I know the things that I know. I'm like, damn, I really wish I'd known it sooner. So pay. So typically you might get a weekly wage, and a weekly wage is usually can be paid into a bank account or cash. And it really depends on the type of business you're working for, because smaller businesses tend to prefer cash because it's smaller finances. Businesses are charged a lot by banks to process payments and things like that. And then larger organisations prefer bank transfer because it can be really complex having large sums of money around to pay people. So it's actually in their interest really to start to process it through bank transfer. But typically, if you're on weekly pay, you will get something like this that appears on your payslip, which is PAYE. So this stands for pay as you earn. And basically this means if you work more hours, you get more pay. And pay usually leads to wages being paid weekly, but not exclusively. But most smaller employers won't have lots of money around ready to kind of pay you. Then there's monthly wage, which gets paid monthly and will be processed through bank transfer generally. I've never known of an instance of it being paid in cash, but yeah, that could change. Someone might appear and say, actually I do, but I'll be pleased or kind of intrigued to know to see if that happened or know how that works for the business. And then there is salary. So salary is a set amount of pay you'll receive each month. You will have contracted hours, but you may be expected to work additional hours for no additional pay. So essentially, you will have the security of the salary, but you won't get any extra money for any extra work or hours that you may do that's outside of your contract. Whereas with pay as you earn, you will, but with pay as you earn, you don't necessarily have the guarantee of having income. So your money is income. There we go. Okay. So most of us will have, or most people kind of get a monthly wage, and it's fair to say that this is the way we kind of think of this, and that wage then goes into what we call a current account. You may still have a student account with your bank, but this will, as you get older, transfer to a current account. So think of it as a student account or current account. And then from that, we have expenditure. This is how most people, in base terms, think of their money. I have my monthly wage comes in, it goes into my bank, and then it gets spent. Okay, and this thinking, along with a couple of other mistakes people make, cause us problems, because really it's a bit more complex than this. And we're going to go through the next few slides and kind of understand those differences, okay, and what we can do to make it better. So the first thing is that people forget their payments. So what happens is when you set up like a bill with, say, open a mobile phone contract, they will say, do you want to pay through direct debit? Okay, what that means is you can set up an order that comes out every month, which basically means that the payment gets processed automatically, so you don't have to call up or go anywhere and pay for it. It's super convenient because it means that we don't have all the hassle of doing it. But what happens as a result is people forget that it's going to come out of the bank. Okay, and because of this, you forget when it happens, and so if you have a bill at the end of the month, which leads on to us next point, and you get paid, say you get paid on the 26th of November, and you have a big bill come out on the 23rd of December, because remember you get paid on the same day each month, you may spend it all, okay, prior to it. And so by not setting aside the bill money, which is the second point, people fall into the trap of then having to borrow or take a loan, and a loan could be something from a private or a company or a bank. Borrowing is usually what you say to your kind of family or friends, but it's still essentially a kind of like a private loan, but without any interest. And then as a result, people put themselves in what we call negative equity the following month. So because you've got to pay those people back, that means your next following lot of income, then a portion of that gets spent on paying people back. Okay. And then the final kind of general point mistakes people make is checking bank balances at cash points. So cash points don't necessarily have all of your transactions up to date at any given point. So when you go to a cash point, generally they will take the cash balance that was there at midnight. So what happens is at the end of the working day, during the night, all payments on cards get processed. Okay, and that means the bank account gets updated at that time. So when we get to Friday and Saturday, Friday night, when it happens, that balance stays there till Monday morning. So anything you spend on Saturday won't show on Sunday if you're checking your bank balance at a cash point. So you might go out Saturday, spend some money, wake up Sunday and go, oh, I've got loads of, check your cash point because you want to buy something, you've got loads of money left, and then you go and spend it. Then Monday morning, when all those transactions catch up, you could find yourself not having enough money in your bank. Okay, and you find yourself what's called overdrawn, and then the bank will send you a text saying basically if this money isn't in there by then, you will get charged £5 a day, up to £80. So every day you're in over, you'll be charged £5 on top for 80 days. It's called unarranged overdraft. So it sounds quite scary, but generally what you should do to resolve it is check your bank balance on your app. And on that, you will have your current balance, in other words, where the transactions are on the Friday night. If it's Sunday, you'll have and then you'll have available balance, which is what you have available based on once these transactions come out. So once these things that you spent on Saturday come out or Sunday, this is what you're going to have left. It is that version that you want to be checking, and to do that, you can do that on your app. Some cash points do have it, but most don't. Okay, and that's one of the mistakes that's caught me out a few times. Okay, when I was younger, especially, and it's something that you have to be aware of. So the first rule to kind of resolving this is to have two bank accounts. And this sounds a bit crazy, right? So let me explain. So first we have that monthly wage. I said before this diagram's a bit more complex. Well, that's because before you get that monthly wage, what happens between your employer and it coming to you in that monthly wage is this. You will have your tax come out. This is really good because in America they get paid their wage and they have to pay their own tax, which if you spend it all before your tax bill comes in is a problem. So fortunately we have it taken out before it comes to us. And usually this is about, I think it's like 17%, 20%, something around there. But again, that tax goes on things like healthcare, your doctors, the NHS, it goes on the army, keeping the country safe, it goes on the police and the fire services, it goes towards supplying ambulances. And so, we get a lot of benefits that help keep us safe as a result of that tax. And you obviously get your education paid for from it. So, in addition to that, you will pay national insurance. So this is a much smaller percentage. And basically, national insurance means that when you're older, you will effectively get a state pension. It also means that if you get injured through, let's say, an emergency situation, like let's say a terrorist attack, for example, you will get some form of payouts, insurance payout from the government to compensate for those injuries and the kind of changes that you may have to your life. So by everyone paying a small amount into national insurance, it means people that do experience those horrible things have some form of insurance there to help them. Then we have pension payments. So this is when I left school. This wasn't a requirement. It was only something you did if you wanted to. But now employers are legally required to enter you into a pension scheme as a result of of people now living longer and getting older and having no savings. And the government found that loads of older people were getting themselves into trouble because they hadn't expected to live as long as they had. And as a result, they had no money and they were in poverty. So now they say everybody needs to have that pension in place in order to ensure that they have some form of cash on top of their state pension that comes from national insurance. Then we have, if you've been a student, you'll have your student loans come out. So anything that you have from going to university in terms of any maintenance fees and things like to help towards subsidise your rent and things like that will go out. And again, obviously I pay this and it's so minimal you don't notice it. But the key thing is all these things come out before you get your monthly wage, so you don't have to worry about it. It does it automatically. So once we get the monthly wage, that then goes into it should go into your first account. And from that account, you should have your bills go out, okay? And because it's in this first account, we don't necessarily need to worry about how much, when the bills come out, we only need to worry that we've got enough in there. So you should make sure that you're keeping track of your bills and ensuring that you're leaving enough in to cover them. Then you have any savings you want to make, and this is a point I'll come back to later. But I would strongly recommend saving something all the time. It's a mistake It's a mistake I made by not doing. Okay, so I know when you're young, you start getting some money and you think, yes, this is this. I can go and do this, I can go and do that, and you get the freedom from having the cash. But actually, there are other issues with it later on in your life, and I'd strongly encourage you to save something, even if it's only a small amount. Then we have account 2, and in account 2 basically goes the things that aren't needed for bills and aren't needed towards your savings, and that is basically what we call your play expenditure. So this is money you can use to do all the social things, buy the toys, buy the games, go to cinema, or go out for something to eat. That's that budget, okay, into account 2. So I'm just going to go back a little bit. So bills. So bills can include phone bills, travel expenses, mortgages, water bills, phone bills, food. Anything that is something you need to survive comes under bills. You don't need the cinema to survive. You don't need Netflix to survive. Okay, be really clear with that. These are things that you cannot function in without, like water, food, and a roof over your head. Okay, at a base level. So savings, small amounts, and then we have, or smaller amounts, I should say, and then we have account 2. The reason we have account 2 for the planned expenditure is that then when we have money in account 1 and we have our bills coming out, when we spoke before about that issue between getting paid at the end of the month on the 26th, having a bill come out on the 23rd the following month, there's a big window to accidentally spend that money. And because therefore you're going to transfer your play expenditure into account 2, you therefore won't accidentally spend bill money. Okay, so that is really, really important. It's something that I wish I had known, because it would have saved me from personally getting into a few sticky situations that have happened. So this is the model of which I live by, and it ensures that nothing can be overspent. Okay, so the second rule in solutions, this is about what should the rough breakdown of this bill, savings and play expenditure be, and that is the 50-20-30. So 50% of your monthly pay should realistically go towards your bills. Okay, now these rules, aren't given. Not all of your money is ever going to be 50% on bills. It's not black and white. Okay, well, this is the optimum that you should aim for. If you can get your bills down to even less, that is fantastic, and I strongly encourage you to do it as much as you can. But realistically, once it starts getting higher than this, the other parts of your life are going to suffer. So try and aim at most to get your bills to 50%. If you can't do it, it might be difficult, like when you're starting out as a youngster and you're not quite getting paid a higher rate per hour, you haven't quite got into the positions where you're getting that extra bit of money. This might be a bit unrealistic early on, okay, and that's fine. I don't want you to get bogged down that this is definitely how it has to be. What I'm saying is this is the aim. This should be the aim for you to go towards, okay? Your savings should then be 20% of your income, okay? And then your play is then left down to the other 30%. And this should give you a nice balance between maintaining yourself and sustaining yourself and saving something additional for the future or for the big expenditures that might come, like needing to get a car or needing some extra money towards a deposit payment and so on with rent, or purchasing a mortgage and a house. And then we have the 30% play, which then allows you money to do the things that you enjoy doing, whilst also functioning financially responsibly as an adult. So if we bring those together, this is what the model looks like. Okay, if account 2 has 30% of your wages in, and you only use that card when you're out and do shopping and buy the things that you enjoy buying and doing the things you like and you enjoy doing, you're not going to hit account 1 accidentally, which means your bills and your savings are fine. Okay, so that's the way I would encourage you to start thinking about the way you want to process what you do. So I hope that has been a little bit revelatory for you. It was certainly a light bulb moment for me when I sort of came across this. And so the next thing I'm going to do is look at what I want you to do for the remainder of this tutorial session. Okay, so moving forward, I would like you to use the layout of the previous slide, and I want you to do the following. Firstly, and what I will say is, keep this is private to you. I don't, you shouldn't feel the need to share this with anybody. This is something that I want for you to work out for you. It's not a competition, and I don't want people to be like, oh, you on this, you're on that. I don't want that kind of conversation. This purely has to be about you working out what is good for you or what is achievable for you. So I want you to work out your income for the month. So when I say work out at your age group, I imagine parents might give you some stuff. You might have some part-time work. You might have grandparents that sometimes give you money and things like that. So what I mean is that you might not necessarily have that solid salary kind of income yet. Okay. So write down what you spend and what on. So how much do you spend and what are you spending it on? So think about the last month. Okay, and then what I want you to do is categorize that spending into the 50-20-30. So if you spent money on a phone bill or travel, that goes into the 50 category. That goes into bills category. If you put some money in a savings account, obviously that goes into savings. If you give money to your parents to keep safe for you to stop you spending it, that could go in there as well. Then the fun category, anything you did that was social, of the things I've listed before, things that basically you don't need to do to survive. You may think you need to do them to survive, but think about it realistically. Okay, if you don't drink water, you will die. You won't die if you don't happen to buy that vinyl pop figure that you really want. Okay, so be sensible with it, please. Then I want you to total the current spending in each category. It says into, it should say in each category. So how much do you spend on bills? How much do you spend on savings? How much do you spend on fun? Okay. And I want you to then split your monthly income into 50, 20, 30. So if your monthly income comes out at like £500, 50% then is obviously your 250, and then you need to think what your 20 and 30 is, which I think is 100 and then 150. So I want you to break down what your monthly income then comes up to. So you may need to use maths to do that. Okay, 100%, split it up. So number 6, I want you to see what the differences are between point 3 and point 5. So point 3 is what you actually spend. Point 5 is what you should spend in those categories. And then I want you to think about what changes you're prepared to make to be financially smart. So what changes are you going to make to fit in to that category? Then finally, thinking forward, I want you to calculate what bills you're going to have at uni or when working, depending on what your route's going to be. And I want you to work out what income you might need to generate to meet the bills and still attain the 50, 20, 30 rule. And what I'm going to say is, if the results of this worry you and you're thinking like, oh my God, how will I ever afford to do this? I want you to come and speak to me straight away. Okay, as soon as the next possible chance is about it. Because what I don't want you to do is to be worrying about these things. I want to sort of help you and make sure that you're in a smart place and that you feel confident and comfortable with it. And then furthermore, if your parents aren't so clued up with university and kind of the processes involved and the finances involved, if they want to speak to me as well, then obviously they are more than welcome to. So I've put this PowerPoint on Moodle, so you'll be able to get to this chart. Please can you get to it, and I want you to work through these points, okay? In the meantime, as I said before, Kathy will be doing one-to-ones with you, okay? So thank you and goodbye.